7B AP Macro FRQ. Let's see if we can do it. I haven't seen this one in a while. So assume that businesses are granted a tax credit. Obviously, you have to know what a tax credit is on spending for machinery. Using a correctly labeled graph of the loanable funds market, show the effect of the business sector's response on the real interest rate. So first of all, understand that a tax credit is the idea that for whatever it's for, I guess this is for machinery. If a business spent $1 million on new machinery, at the end of the year, tax year, the government would give them that $1 million back. It's a tax credit. It's the idea that whatever you would spend on machinery, at the end of the year, the government would give it back to you, that whole $1 million. So you could assume that if I was going to get free machinery and the government was going to pay for it, it tends to be an incentive to buy more machinery. So think about that. I would assume, looking at our demand, supply of loanable funds, real interest rate on the vertical, quantity of loanable funds, that if this situation started happening, a lot of businesses are going to rush to the bank, want to borrow money to get new machinery, and know that they're going to be able to pay it off at the end of the year when the government hands them that money back. So I would assume demand for loanable funds increases, and that's going to drive up the real interest rate. Remember, show means arrows. Show the arrows, show the demand for loanable funds, show. Now assume that instead the tax rate on interest income for household savings is lowered and there is no change in the government budget deficit. Using a second correctly labeled graph of the loanable funds market, show the effect of the household response on the real interest rate. Well, now we must assume that we understand what interest income is from household savings. Think of it like this. If I put $100 in the bank and the bank gives me 10% on my money, good luck for that, I would get an extra $10 at the end of the year for putting my $100 in the bank. This would be counted as income, and I would be taxed on that $10. Now they're saying that that the household tax rate on interest incomes would be lowered. This would imply that if the tax rate on household interest income is lowered, more people are going to be willing to save. Our supply of loanable funds would increase, driving down the real interest rate. Real interest rate on the vertical, quantity of loanable funds on the horizontal. Show that supply of loanable funds shifting to the right, and show that new interest rate lower. Given your answer to Part B, explain what will happen to the country's PPC in the long run. Understand that there are a lot of these questions. Once you know what's happening to the real interest rate, we're going to say it the same way every time. Interest rates go down, therefore more people would take out loans. Investment would go up. When investment goes up, we could assume some of that investment is going to be with capital formation. Capital formation is what we use every time to explain this because they will use it every time in their explanations. Capital formation would go up, therefore our PPC would shift out or rightward. There we go. Understand that this they could have asked what happens to your long-run aggregate supply curve. That would have shifted out rightward also. They could have said what happened to long-run growth. All of these are the same things. It would have increased. They could have also said what would have happened to potential GDP, and we would have said that increased also. So know whether they're asking about PPC, long-run aggregate supply, long-run growth, or potential GDP, all of those are the same thing. They are increased when real interest rates go down, investment goes up, and there is more capital goods being produced. Excellent. All right, guys, be safe. Take care.